Here to discuss which retail stocks could benefit the most is Oppenheimer's Brian Nagel. Brian, it's good to see you. It really hasn't been the best year for retail and consumer names, unless you're like in the cruise industry or Amazon or a home builder. Some of them are actually down year to date. So what do you do with these retail stocks?
Well, good afternoon, Sarah. So, look, I think that's a fair assessment. It's been a very, very tough backdrop for consumer stocks. Now, I think the important point there is the stocks. For the companies, and I agree with Janet Yellen's comments, spending has held up remarkably well. Okay, and that's so from a fundamental standpoint, the fundamentals have been much better, I think, than the stocks. Now, the Fed announcement this week to me is pivotal. I think the idea now that the rates have likely topped out and are moving lower, I think it sets the stage very well for more consumer or discretionary stocks as we look into 2024. And so essentially, in my mind, these stocks will begin to catch up or track better solid underlying fundamentals of these companies that we've seen for a while now.
Do you want to sort through some of the ones that have had the toughest go this year? A Foot Locker, I'm just looking, Tapestry, Best Buy, Bath & Body Works, Tractor Supply. They're all down for the year.
Yeah, so those are a few of those names you mentioned I don't cover. Like a Best Buy, I do cover. I would stay away from there. The way I would play this, okay, as I look at what's happening now and then into 2024, and more message to my message to our clients has been, look, the rate-sensitive names. So Home Depot and Lowe's on the home improvement side. The idea that rates are likely moving lower, that's a big positive for home improvement retail. And then another names I talk about a lot on your show and is athleisure. So names like Nike and Lululemon. Lululemon, we've seen fantastic results out of. That stock's doing well. Nike's lagged. Now we're going to get a report from Nike next week. I think the report itself will be generally in line. But again, as we look beyond that report, with the backdrop of a still very solid consumer, lower rates, I think that's when that stock starts to work even more.
Do you worry at all about revenue growth in a time where apparel and footwear prices are either disinflating or deflating? Because companies benefited from those higher prices, didn't they?
Absolutely. And so, the key there is to really understand where elasticity of demand is. So there's categories like the auto parts retailers. Now, my team and I downgraded the auto parts retailers a while ago, largely on that concept. Now, AutoZone, O'Reilly, extraordinarily well-run companies, but there's not much elasticity of demand. So they benefited from inflation. As inflation wanes, that means sales growth or revenue growth will be slower. But if you look at companies like Nike, again, I'm going to keep on highlighting Nike, there's more of an elasticity of demand. I don't see Nike dropping prices, okay, to be clear. Nike's done a very good job on the innovation side. But as inflationary pressures broadly subside, as the consumer feels better, from an inflationary standpoint, you could very much see better improved unit demand for a Nike. So that's essentially how. But again, the companies you want to be careful of are those that are primarily driving sales growth through higher prices. And again, from my coverage universe, I would highlight the auto parts retailers.
So since you were zeroing in on Nike, let's talk about it. Reports earnings on Thursday. It has lagged. I think it's up like 3% this year, but it's still valued at 32 times next year's earnings. Where's Lulu? In the 30s somewhere. Why do you think, first of all, Nike's been punished, and what do you think it's worth?
Yeah, so look, Nike's, so a 32 multiple is not low, right? If you look across the market,
that was kind of the point.
But for Nike, it is. Okay, this is Nike. This is one of the most dominant global brands on the planet. Okay, and historically, we've seen that multiple significantly higher than 32 times. So when I think about where that stock should be priced, I look back at history, particularly in environments where rates are lower. That's when Nike tends to get a higher multiple. Now, fundamentally, this has been a classic wall of worry type stock. Okay, so as I talk to investors out there, there's been worries about China. There's been worries about demand growth within the United States. There's been worries about inventory. And one by one, Nike, with its very solid fundamentals, has essentially tackled those type of worries. And again, as we look into 24, I think those concerns that have weighed upon the stock further abate. The inventories are now clean. I think we're still seeing solid demand in the United States. I think that's going to get better as Nike ships more product to its wholesale partners. And everything we're hearing, despite the worries of some type of economic malaise in China, what we hear from Nike and then frankly from Lululemon as well is that demand for these products is quite good.